Welcome back, my friends. Just when you thought interest rates were getting to their highest levels, it looks like they are not. Many thought that the Federal Reserve was getting close to the end of raising interest rates. But now, Federal Reserve Chairman Jerome Powell is saying the exact opposite will probably happen.
We think there's a reasonable chance that the Fed will have to bring the Fed funds rate to 6%, and then keep it there for an extended period. BlackRock's Rick Rieder wrote.
So, what does this mean for commercial real estate? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. The world's largest asset manager sees the U.S. federal funds rate peaking at 6%. After Fed Chair Jerome Powell warned interest rates are likely to head higher than the central bank previously expected. We think there's a reasonable chance that the Fed will have to bring the Fed funds rate to 6%. And then keep it there for an extended period. To slow the economy and get inflation down to near 2%. BlackRock's chief investment officer of global fixed income Rick Rieder wrote in response to Powell's testimony before the Senate Banking Committee on Tuesday. The economy is more resilient than expected, Rieder said, pointing to the most recent jobs report and consumer price index reading. This is partly due to the fact that today's economy is no longer as interest rate sensitive as that of past decades, and its resilience, while a virtue, does complicate matters for the Fed, he wrote in the note. BlackRock's call for a terminal rate of 6% comes as Morgan Stanley economists said Powell's commentary opened the door to resume to larger hikes of 50 basis points. In February, the central bank raised rates by 25 basis points, bringing the federal funds rate to a range of 4.50% to 4.75%. A 50 basis point hike would bring the rate to a range of 5% to 5.25%. The Federal Reserve is slated to meet on March 21 to 22. Emphasizing the U.S. economy's resilience, Rieder compared it to polyurethane, a durable material described by the American Chemistry Council as flexible foam. We've recently likened the U.S. economy to polyurethane, which is a remarkable material that displays flexibility and adaptability, but also durability and strength, he wrote in the note. The material's ability to be stretched, bent, stressed and flexed without breaking, while in fact returning to its original condition, is what makes it so chemically unique, he said. In its latest report, the U.S. reported an increase of 517,000 non-farm payrolls in January, significantly exceeding market estimates. While the unemployment rate fell to 3.4%, the lowest level since May 1969. The next report is expected Friday, and is likely to continue to show a resilient labor market, despite the Fed's aggressive rate hikes to tame inflation. Economists surveyed by Dow Jones estimate 225,000 jobs were added last month. Interest rates play a crucial role in the world of finance. They determine the cost of borrowing money and the return on investments. In the case of commercial loans, interest rates have a significant impact on borrower behavior and, ultimately, on loan defaults. So what are the effects of interest rates on commercial loan defaults? And how lenders can mitigate these risks? Interest rates can influence borrower behavior in several ways. For example, when interest rates rise, borrowing becomes more expensive, and borrowers may be less likely to take out loans or expand their businesses.
Additionally, borrowers with variable rate loans may see their payments increase,
putting a strain on their cash flow. On the other hand, when interest rates are low, borrowing becomes more affordable, and borrowers may be more willing to take on debt. This can lead to increased investment and economic growth. However, low interest rates may also encourage borrowers to take on more debt than they can afford, which can lead to defaults if economic conditions change. Interest rates can have a significant impact on commercial loan defaults. When interest rates rise, borrowers with variable rate loans may struggle to make their payments, leading to defaults. Additionally, rising interest rates may lead to decreased economic activity, which can put a strain on businesses' cash flow and make it more difficult for them to repay their loans. Conversely, when interest rates are low, borrowers may take on more debt than they can afford, leading to defaults if economic conditions worsen. Low interest rates can also lead to increased competition among lenders, which can result in less stringent lending standards and higher default rates. To mitigate the risks associated with interest rate fluctuations, lenders can take several steps. For example, they can offer fixed-rate loans to borrowers, which provides stability and predictability in terms of payments. Lenders can also implement strict underwriting standards to ensure that borrowers can afford the loans they take out, even if interest rates rise. Additionally, lenders can diversify their loan portfolios, spreading their risk across a range of borrowers and industries. This can help mitigate the impact of economic downturns in specific sectors or regions. It's a major sign of struggle when huge office landlords are defaulting on their loans. Brookfield is the largest office landlord in downtown Los Angeles. And now Brookfield is suffering blows from dissolving demand and rising interest rates. The corporation defaulted on loans tied to two office skyscrapers in the city: the Gas Company Tower and the 777 Tower. These two iconic buildings carry loans totaling $784 million. This is according to multiple recent SEC filings. First of all, what are these properties? The Gas Company Tower is a skyscraper located in downtown Los Angeles. It is a 52-story building that stands at a height of 757 feet. It is one of the tallest buildings in Los Angeles. The 777 Tower is a high-rise office building located in downtown Los Angeles. It is a 52-story skyscraper that stands at a height of 725 feet. It is also one of the tallest buildings in Los Angeles. The 777 Tower was completed in 1991. The 777 Tower is located at the intersection of 7th and Figueroa Streets. That is considered a prime location in downtown Los Angeles. Brookfield's portfolio has a total of $2.28 billion in secured debt. $500 million is due in October, and $263 million maturing in November. Office vacancies have increased across the United States. The downtown LA market has been struggling even since before the pandemic. The vacancy in the Central Business District is up to 24.5%.
And you already know about major lenders backing away from residential mortgages.
Wells Fargo is stepping back from the multi-trillion-dollar market for U.S. mortgages. This comes amid regulatory pressure, and as the Federal Reserve continues to raise interest rates.
Wells Fargo will now only offer home loans to existing bank and wealth management customers.
The banking giant thinks that the lending market has collapsed. As you probably know by now, the Federal Reserve began aggressively raising rates last year. Wells Fargo is also concerned about an heightened regulatory oversight. Mortgages are by far the largest category of debt held by Americans. Wells Fargo was the country's top mortgage lender as recently as 2019. Now Wells Fargo pursuing more revenue from investment banking and credit cards. The big U.S. banks stepped back from home loans after the housing bubble of the Great Recession. Wells Fargo is currently the largest mortgage servicer in the United States. Altogether, the shift will result in a fresh round of layoffs for the bank's mortgage operations. Wells Fargo cut thousands of mortgage workers last year as business declined. The news does not really come as a complete surprise to investors or employees. Wells Fargo said it was investing $100 million for minority homeownership. Real estate values have fallen across the nation, and macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets.
Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission.
The real estate funds have recently seen a surge in withdrawal requests. It comes amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone right amassed $68 billion in assets. But what a difference a year makes. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private right. As you might imagine, in a degrading real estate market, publicly traded rights have gotten slammed this year. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.